Recently, Atan came back and asked, Siao Liao lo, banks also tio taiji liao liao. How about REITs leh? Can invest REITs now? The short answer is no for now. In this video, I will be sharing you with 3 reasons why you should not be investing REITs for now. Reason number 1. If you want to invest in Singapore REITs, you might as well invest in STI ETF. As you can see from the chart, past 2 years overall Singapore REITs has been underperformed against the STI. If we were to look at the Singapore REITs, which for this case, we look at the Lion Phillips Singapore REITs, which holds the bulk of the established Singapore REITs listed in the Singapore SG. We can see the list of REITs constituents itself. The 4 major holdings will be CapitaLand, Mapletree, Fraser, and Keppel. This also coincides with the STI, as the 4 major names are part of the STI constituents. Aside from that, you get the local banks and other conglomerates such as Wilmer and Jardine to diversify off sector risks. Topping off, most Singapore REITs since pandemic has declared semi-annual dividend payout instead of the quarterly dividend payout. Yes, you can say as long as the distribution is the same or better, it doesn't matter. It does matter in terms of frequency, as some investors are looking for frequent income such as retirees, and this does impact their cash flow. If the REITs are giving semi-annual payment, then the STI ETF can be another alternative, as it also does a semi-annual dividend payout with a distribution yield of 3.71%, which is not too far from some REITs distribution yield. Reason number 2. We know that for dividend yield to be high, the price of shares needs to fall. For REITs wise, the share price of the 3 major REITs like Capital Integrated Commercial Trust, Fraser Logistics and Commercial Trust, and Mapletree Industrial Trust is currently trading at $1.98, $1.31, and $2.37 with dividend yield of 4.51%, 5.66%, and 5.10% respectively. For NAV wise, Capital Integrated Commercial Trust is the only counter of the 3 that looks to be trading at a discount to NAV level. In the current interest rate environment, investors will expect a higher yield as the risk premium is higher in investing REITs currently than fixed deposits or T-bills, which can yield 4% at risk-free rate. If investors were to demand a higher dividend yield, like example 7%, then the share price for Capital Integrated Commercial Trust, Fraser Logistics and Commercial Trust, and Mapletree Industrial Trust to be trading at $1.51, $1.08, and $1.97 based on full year 2022 distribution. With that in mind, there will be some headroom for REITs to fall with the increased interest rates that leads to higher borrowing costs. US office REITs listed in SGX are also not spared, as the uncertainty in US markets looms with occupancy rates declining in the West and higher gearing ratio persists as debt increases. Reason number 3. Investors could expect more right issues, private placements, or other action that requires raising of funds such as divestment of some properties moving forward. Be it in the case of asset acquisition or worse still, debt repayment or paying of dividends through right issues, there is a large chance that the earnings will be further diluted. In another video, I also share about the suspension of MIT dividends reinvestment scheme and how it will affect the NAV. Another point to take note is that some REITs are also divesting or have divested some properties in order for some gains or are re-strategizing their assets approach. However, such moves are only good for short-term gains, and for longer-term wise, the NAV of the REIT will also be impacted. Atan asks, you say so much, so when is a good time to enter REITs? The simple answer is, I don't know. There are still episodes of US banking news waiting to unfold, which could further aggravate the stocks market. And by looking at the CME Fed Watch, there are still near 50% possibilities of 2 rate hikes going in May and June, and suggesting an easing of the interest rate in September. So this could suggest that the next 2 quarters, which is about 5 to 6 months, are not ideal to invest in REITs, as there are still headrooms for the share price to further fall unless the dividend yield has hit your entry price, provided the REIT is still in strong fundamentals. Anyway, this is not a financial advice, and do your own due diligence, Atan. With that, these are my 3 reasons on why you should not be investing in Singapore REITs now. Let me know which Singapore REITs are you currently looking at and how do you feel about the current REIT sentiment. Do like and subscribe to my channel. Adios.